Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Northern Trust produces an annual capital market assumptions report of long term averaged annualized return expectations for a wide range of asset classes. This year, it forecasts below trend global growth at an annualized rate of 2.4% over the next 10 years, moderating developed market inflation of 2.4%, and a lower global equity return of 6.3% per year on average. The report's asset class forecasts are driven by six key themes that Northern Trust investment experts see affecting markets and the economy over the next 10 years. And those themes are restraints on global economic growth, geopolitical fault lines, adaptation to persistent inflation, central bank concessions to inflation, a sustainable green transition, and growing private markets. My guest today is Chris Shipley. He is the Chief Investment Strategist for North America, responsible for the strategic and tactical asset allocation policy for its institutional and wealth management clients. Chris chairs the Northern Trust Tactical Asset Allocation Committee and is a voting member of the Investment Policy Committee. So, Chris, you were a guest on my podcast a year ago. We discussed last year's CMA report at that time. I know that you've had a 23-year career at Northern Trust, but for those who weren't with us at that time, tell me about your career path and your role now.
Sure. And first off, thanks for having me back again. I started my career as an equity analyst and started specializing in the financial sector when I came to Northern 23 years ago. I was the analyst that covered the banks during the financial crisis, which was a very character building exercise, as you might imagine, particularly while working for a bank, and later became director of equity research and then head of fundamental equities before shifting over to my current role as the strategist for North America. So very much a fundamental background, and I still stay very close to the bottoms up world in my top down work.
Terrific. Well, we're going to talk about this year's forecast, but first, I listened to our podcast a year ago, and by the way, I'll put a link to that in the notes that accompany this podcast. But I went back and I looked at our conversation then and some of the things that you said. You correctly predicted that inflation would recede despite continued upward wage pressure. You also forecast a monetary drought, meaning that the Fed would tighten its monetary policy. You correctly forecast higher rates, and the 10-year yield is about 80 basis points higher than when we spoke a year ago. But you predicted subdued returns for U.S. equities, but equities have returned about 16% over the last year. And I realize your forecast was for a longer time horizon, and I'm only looking at 1 year, but has your outlook changed for U.S. equities? And more generally, is the market in a bubble, as many observers contend it is?
Well, I certainly appreciate you acknowledging that I wasn't wrong on everything, but equities have certainly outperformed expectation, particularly U.S. equities, which have significantly benefited from the mega cap tech trend this year, and that's despite the rise in interest rates that you mentioned. As you know, growth stocks do have longer durations, meaning greater sensitivity to rising long rates because more of the value of a growth company is further out in the future, which has to be discounted back to present at a higher interest rate, which hurts the present value. But growth stocks have overcome that headwind this year, particularly the so-called Magnificent Seven, which have benefited significantly from the enthusiasm toward AI. And as a result, the broad market averages really mask what's happening underneath the surface, which is far less impressive than the 16% price change we've seen year to date over the past year for the S&P. And specifically, if you look at the equal weighted S&P, or how the average company in the market is doing, it's up only 4% on a price change basis. Now, to be clear, we're not discounting the significance of the AI boom. You look at NVIDIA and their earnings revisions based on real demand for their GPUs is what's moving that stock, not just investor hope. But one could argue that the halo effect of that real demand is pulling up some adjacent companies perhaps a bit more than is justified. But bottom line, with the S&P at 19 times forward earnings estimates, and frankly, those forward earnings estimates look optimistic to us, we think that the near term setup for stocks is fairly unattractive. And the next 5 to 10 years looks somewhat below trend as well, with our 10-year annualized return expectations for global equities a bit over 6%, as you mentioned.
Well, great. I want to now turn to your report that you just published for this year. What does the next decade of growth look like for the global economy? Where is there upside? How can investors target their portfolio to mitigate risk?
Sure. Well, we do expect that growth will be held back by several restraints over the next 10 years, leading to slower growth than what we saw over the past decade. And carrying over from previous years are our concerns around the longer term implications of elevated debt loads in the public sector and what that foretells about the potential for less supportive government spending or higher taxes, each of which is suppressive to growth. The other very long term headwind that we note is demographics, where aging populations alter the consumption dynamic as well as the size of the labor market. But increasingly relevant over the next decade, and we have as a couple of our themes, are the geopolitical tensions and what that means for globalization, as well as the movement to sustainable sources of energy, both of which we expect will be somewhat suppressive to growth. While investing in rerouting supply chains or shifting to more sustainable sources of energy do represent economic activity, it largely represents a replacement of something that we already have and technically works, at least from an economic perspective, suggesting that investment here is likely to crowd out more economically productive spending, representing an incremental constraint on growth. And we also expect that those factors will be somewhat inflationary, which I'm sure we'll talk about, which is going to keep interest rates higher over the next decade. So, from an opportunity perspective, we do think that fixed income returns look a little bit more attractive going forward, particularly when faced off against these more modest equity returns. In fact, our forecasted return differential between equity and fixed income are about as narrow as I can remember, suggesting you're getting less bang for your buck in stocks relative to bonds based on this growth and inflation outlook.
I have seen a fair amount of analysis lately about the historically low level of the equity risk premium. So I get why deglobalization is a restraint on growth. Why do you believe that the green transition will also lead to somewhat subdued growth?
Yeah, it's actually a very similar story economically. So if you think about rerouting supply chains as part of deglobalization or regionalization, nearshoring, friendshoring, et cetera, however you want to refer to it, it all represents the replacement of something with that is currently working with something that is probably going to end up being somewhat more expensive, or at a minimum is taking investment that would have been put to use elsewhere, probably more productively, at least economically. The similar story is true in the green transition, where you are taking something that works, fossil fuels, and you're de emphasizing that for reasons that are not economic in nature, at least on an intermediate term basis, and shifting that into technologies or alternative sources that are more expensive and does crowd out other investments. So it's that crowding out effect. It's effectively that insurance premium that you're paying for getting more durable sources of supply chain or more durable sources of energy over time. Think about the US energy independence comes from fossil fuels, but areas like Europe or China, they're dependent on imports of fossil fuels in order to maintain energy consumption. And so they're motivated to try to make these shifts. And again, not always economically motivated, but instead driven by an appreciation for energy security as well as the needs for the from a climate perspective long term.
I think the two biggest concerns that our listeners have are one that we already talked about, whether the equity market is in a bubble, but second, whether we're headed for a recession. And the yield curve is still inverted. It's been inverted for a while. The leading economic indicators are in recession territory, and higher interest rates have caused an uptick in bankruptcies, particularly for small and some mid sized companies. Will there be a recession?
Yeah, it's a good question. And frankly, I'm glad you led with the headwinds because it does seem that those are getting relatively little attention these days as the equity market climbs higher. I do think it's fair to say that the economy to date has been a lot more durable than almost anybody would have expected, which has certainly been aided by the relative insensitivity to short term rates in the economy, at least here in the US, where consumers have fixed rate mortgages, larger companies are funded in the capital markets and have termed out their debt. And that has certainly helped to lessen the blow from higher interest rates, at least so far. What we do know is that incremental investment in the economy is being impacted in a fairly significant way. But by only affecting that incremental investment in the economy as opposed to the existing stock of debt means that it's taking longer than normal for monetary policy to significantly influence the economy. But there are other headwinds that are accumulating, most notably of which is the consumer, where the consumer has been spending at a level that is above wage growth, thanks to the spending down of excess savings that were built up during the pandemic, as well as the re-leveraging of revolving debt. In other words, the borrowing on credit cards is and the pay down of or the wind down of excess savings is really helping the consumer to basically manage through this inflationary period by outstripping their wage growth in terms of spending. With those balances on the credit card side now comfortably above 2019 levels, and the majority of that excess savings being spent down, particularly in the lower income cohorts, we do think that that's going to represent an incremental headwind to the capacity of the consumer to spend, even if their willingness to spend remains relatively high. So you add all this up, and it suggests to us that things are certainly going to slow down. Whether or not we actually have to enter recession, we're not making that call as a base case, at least in the US, where we do think it's still possible that we can avoid recession, but we certainly expect that things will slow down as these headwinds are ultimately felt by the economy.
The U.S. consumer has certainly shown a remarkable resilience to be able to spend at the rates that it has. Despite these higher rates, high inflation has persisted. What factors are keeping inflation high, and how do you account for upward pricing pressure in your outlook for economic growth?
Yeah, so as you know, really, inflation started as a bit of a mismatch between what had become shifting consumer preferences during the pandemic and shuttered supply to deliver the goods that consumers were looking for. And then we shifted very quickly to the consumption of services, which was outstripping the ability of the labor supply to move to that part of the economy, which drove price inflation as well as wage inflation. And wage inflation is challenging because it represents that capacity to spend issue that we were just talking about. And so with wage growth comes spending growth. And now we are in a disinflationary regime. We've seen headline and core inflation decline significantly from the peak of last year, but we always knew that the path from 9% to 4% would be easier than the path from 4 to 2, right? And so, with supply chains moving, the green transition and what that means for commodity prices, the tide shifting toward labor in this kind of capital versus labor debate, given demographics and other issues, as well as the higher interest rates just ultimately impacting interest costs in a way that will likely be passed along in the form of higher prices, all represent these long term headwinds to inflation that we expect will keep inflation above the Fed's preference of 2% over the next decade. But for now, while elevated oil prices and are going to challenge headline inflation numbers, and rents may be impacted by this lack of housing affordability that we're going through right now, we do expect that inflation will continue to moderate, but it's probably going to stay above those central bank preferences for some time.
The Income Strategy Symposium brings together experts and thought leaders to help you generate more income for your clients. Join us on Friday, October 27th for this free event at etftrends.com/webcasts/income strategy symposium.
When you say it's going to stay above those central bank policy levels, what are you thinking about will be the new equilibrium? Is it 3%, 3.5%, closer to 4%?
So it's a good question. We think that inflation settles out at around 2.5% over the next decade. What that ultimately means for whatever the neutral rate may be for the Fed or their preferences, some of this comes back to the theme that you mentioned at the outset, which is central bank concessions, where we do believe that the Fed and other central banks may have to ultimately acquiesce to inflation that is somewhat above their 2% targets, as it's simply not worth the incremental damage to the economy in order to achieve those 2% objectives. And so we're watching this trend very closely. But at least for now, when it comes to the near term as opposed to the longer term, the dual mandate Fed, they're tasked with maximum employment along with contained inflation. They're certainly willing to sacrifice the maximum employment side of things as almost a necessary condition to achieve more contained inflation. Central banks are certainly slowing the economy relative to had they done nothing. But as again, for reasons we've discussed, the economies are certainly holding up better than expected. But we do think that central banks are probably almost done for this cycle. And that while slower, the US can probably avoid recession, at least a substantive one. But that longer term debate becomes interesting again around whether or not 2% inflation is really achievable without really pressing on this economic harm issue. But again, we think the Fed, while probably not formally changing their frankly relatively arbitrary 2% target, will ultimately accept inflation that is somewhat higher than that, as the economic damage to get down to 2% just won't be deemed to be worth it.
Looking more globally beyond the Fed, is it possible for the other central banks to reach their inflation levels without causing undue economic harm?
So we do think that there are challenges that exist outside the US for central banks. When you look at the labor markets in areas like Europe, it's clearly more challenging than what we have in the United States, in part driven by the higher percentages of the workforce that are tied to some type of collective bargaining, unionized labor, and so forth. When we look at those and we see some of those longer term increases in wage inflation that are being built in today via negotiation, that creates a little bit of a longer term challenge that the ECB and others may have to overcome relative to what the Fed may have to do here in the United States. So, like the US, we think that interest rates are probably going to remain at an elevated level for longer than what the market is assuming. And when you look at the influence of those higher interest rates on the economy within areas of, say, Northern Europe, where you have a higher percentage of adjustable rate mortgages, that is certainly going to be problematic when it comes to the economic outlook. And of course, areas like Germany are already essentially in recession based on exceedingly high commodity input costs into their productive capacity. So when we look at the trend overall for areas outside of the US, we do see some of those economic challenges being a little bit more difficult to manage through, but ultimately necessary in order to achieve these inflation objectives on the part of central banks.
When we speak, there always seems to be a hot topic that I'm able to ask you about. Last year, when we spoke, it was the fact that the euro and I believe the pound were both near parity with the dollar. That, of course, has changed. It seems like ancient history now. Today, the hot topic is artificial intelligence, which is expected to have an enormous growth potential. How much of that will impact investors in the near term? And what needs to happen for investors to tap into the long term financial benefits of AI?
Yeah, it's a good question and certainly a difficult one at this early stage, but I'll share how we're thinking about it. So, first, we are confident that AI will be consequential to the global economy and to investors over the next decade. But how consequential is far less clear. There are certainly constraints on AI's impact. There's the physical limitations of the silicon itself, which is not insignificant when considering some of the very optimistic forecasts of its potential impact. TSMC can only make so much. And these large language models, as an example, require an enormous amount of compute power, and that's only for text. So, again, there's a huge amount of demand for the silicon, of which we may have somewhat constrained supply. The other constraint is political. And we've already seen areas like China and Europe hamstringing its potential, and the US will no doubt follow suit in some fashion. So, we're mindful of the fact that there are some restraints on just how significant AI can be. In the short term, again, a lot of the market psychology this year has been built around this. I mean, imagine what the S&P would have done this year had ChatGPT not been released in the fall of last year. We wouldn't have had any of this AI enthusiasm that has played such a dominant role in markets today. So we're watching these issues closely. It feels like much of the enthusiasm, at least from a short-term perspective, is probably in the markets. The longer-term questions are going to be, what does it do for productivity? What does it do for growth? And at this point, it's very difficult to say, other than that it's probably going to have somewhat of an offsetting effect to the other inflationary forces that we see in the economy, but probably not sufficient to offset them completely. So again, leading to that higher inflation over time.
You mentioned TSMC, just to clarify, that's the Taiwan Semiconductor Manufacturing Company, right?
Correct.
Allocations to private asset classes like real estate, infrastructure, commodities, and maybe even hedge funds and private equity have increased rapidly in the last decade. What place do these historically illiquid asset classes have in investor portfolios in the decade ahead?
Yeah, it's a good question. Private markets in particular have grown considerably over the past 10 to 20 years. And with that growth has certainly come continued maturation of the private equity and private credit asset classes, including significant growth in secondary market transaction volume, which means better liquidity opportunities and, frankly, better price discovery, which just makes private capital more attractive to investors as we go forward. And then when you look at the role in the economy, we see private markets continuing to take share. When you look on the credit side of things, given the growing regulatory burdens that are being placed on the banking system globally, with the US regional banking issues being only the latest example, we do expect further disintermediation to the benefit of private markets as banks are becoming somewhat less efficient allocators of capital and multipliers within the economy. And then on the private equity side, we expect that liquidity developments in private markets will allow for companies to remain private longer, allowing for more of that value creation to occur prior to going public, with the growing inconvenience of being a publicly traded company offering some incentive to stay private longer. All of that means that we should see private markets continuing to play a greater role in the economy and, frankly, in investor portfolios over time.
One of the geopolitical risks that has drawn a lot of attention is the rivalry between the US and China. That's caused an elevated risk that ties into Taiwan and its semiconductor manufacturing dependence that the US has. How can investors navigate the market volatility that comes from having such a range of possible outcomes relative to the risks that are present?
Yeah, it's a good question. And when you think China specifically, China was clearly the biggest beneficiary of globalization after it was admitted to the WTO back in 2001. And I think it's fair to say that China stands to be the biggest loser of deglobalization. Supply chains are already moving, but it takes a long time. And foreign direct investment into China has already collapsed, and technology restrictions will challenge business activity in China. So we actually think that non China EM has the potential to benefit over time, including areas like Vietnam, India, Mexico, which all stand to be part of the solution for what has become too great a reliance on China over the past 20 years. And when it comes to how to navigate this from a portfolio perspective, we are underweight emerging market equities tactically due to China's current and, frankly, longer term structural challenges. And we would take a cautious approach to investing in the region and focus more heavily on the beneficiaries of countries and companies de-risking going forward. Again, some of that non-China EM probably has some pretty good opportunities over time. In the near term, China has a lot of influence over the broader emerging market indices, and with a lot of the challenges there remaining and seemingly relatively modest levels of stimulus, either financial or economic, coming from the government there, we would continue to take a cautious approach to near-term investing in the region.
Last year, if I remember correctly, you were overweight U.S. high yield bonds. This year, you just mentioned you're underweight emerging market equities. I believe you're underweight U.S. equities based on your forecast earlier for subdued returns. What are the significant overweights and underweights that you have now in your asset allocation?
Yeah, it's a fairly straightforward mix right now. So we are modestly underweight risk, is how I would characterize it. We do have an underweight position in all of the three equity regions that we identify from a broad asset class standpoint, that being the US equity market, the developed markets outside the US, as well as emerging market equities. We're underweight each of the three regions. And the developed market underweight, we are basically we're taking that capital and putting it to work in high yield, where you have 9% coupons, you have a backdrop economically and corporate profits that still looks reasonably durable, that we think credit losses will remain low. And so we think that the return prospects for high yield are better, and you have better downside protection in the event that the equity market retreats. Our preference for natural resources over emerging markets is another one that I would call out, where they're exposed to similar economic trends, but natural resources don't have the same exposure to geopolitical risk, at least in the negative way that China has. So we prefer natural resources to EM equities as well.
If there's one key takeaway that you would like to leave with our audience of advisors, particularly those who are helping their clients plan and save for retirement over 30 plus year time horizons, what would that be?
Well, as always, I think it's incredibly important to remain disciplined in asset allocation, where you're arranging in your portfolio in a way that meets your long term goals and really not getting shaken out of positions at the wrong time. Keeping an eye on the horizon, being that steady hand, and really not allowing clients to let short term market gyrations lead to unproductive trades, either succumbing to the weight of a down market or chasing a rising one. And while equity returns may show lower returns than we've seen over the past decade as we go forward, better fixed income yields should provide some offset in that 60-40 world, keeping clients on track for that retirement.
Well, we'll include some links in the notes that accompany this podcast. There'll be a link to the Northern Trust Capital Market Assumption or CMA report, a link to the press release that announced that CMA report, and I'll also include a link to the podcast that Chris and I did in October of last year. Chris, is there anything else you'd like to add?
Just my thanks for having me back on again. Really appreciate it. Enjoyed the conversation.
My pleasure, and I look forward to doing this again in a year, if not, if we don't have the opportunity to touch base sooner. Thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Chris Shipley of Northern Trust. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.